All right. Good morning, everybody. New week. So we're gonna get into that blackout period where voting members will go quiet. That'll open the media stage for non-voting members and Secretary of Treasury Scott Bissett to chip their teeth. It also just leaves a void in the airwaves. So who's going to fill it up? Very likely the administration and their continuing shenanigans, bunch of headlines. It's just noise, right, in front of the data. So keep your eye on the prize. Small caps up the most this morning. Last week, we started to see little signals on a short squeeze coming. These don't last. They generally come with very minimal warning, hit for anywhere from a week and a half, 2 weeks at most, and then they fade back into obscurity again. There's a few tells when it comes to playing this short squeeze, and of course the easiest tell is the small caps leading, but it's more nuanced than that. We might get into it on a different day, but you can look at an ETF called IPO. Some of the ARC ETFs kind of fit into this. And just keep your eye on some of those old Reddit board list names like GME, AMC, those guys, right? They're often a really good tell too. And then, like an odd one, Kroger has had that short squeeze before. Nowadays, Kroger's a part of a bigger portfolio. I don't want to say Berkshire because I don't think it's him, but you get the idea. It's one of those big names, right? Like if it isn't him, then maybe it's Icon or one of the others. Just a little bit of a sea change, it seems. Other than that, we've got 0.5% to the downside through Europe and about 0.5% to the upside into the Americas. That lack of influence as we go into the noon hour really isn't going to offer us very much. If we had more influence from them, negative or positive, then we could see or anticipate some change into noon. But at this point, they didn't give us any. They're not going to take any. Wholesale inventories can influence the GDP forecast. So this is kind of a big deal. It's a part of the narrative and conversation today with everything that's going on with this spending bill. So keep your eye on this headline number. It shows as a low impact event, but just, given the current market backdrop and the media headlines, don't let this one slip past you. So it's 10 a.m. Be ready for, some violence on that one. And the president's going to be talking at 2 o'clock, which gives him a chance to shake the markets up a little bit. So the afternoon is going to carry that threat. We want to watch for this potential hurry up and wait pattern to start to emerge. The put wall is now in between the volatility trigger and zero gamma. The put wall is considered to be a mild support level, only from the idea that we expect them to monetize puts when price gets down into that level, which should be supportive of market price. It's also right on top of the 10-day moving average. So that is also supportive of price. And it's really close to a major options level, 59.50, which is where basically the 4-period moving average is. So we've got a lot of structure down here around that 59.50, and we really need to keep it. Below that, we've got Friday's low, 59.32 cog line right in front of the 0 gamma. Look at it as a cascade of failure. The volatility trigger doesn't hold, we're going to test that put wall. If that doesn't hold, we're going to get into the 0 gamma. And what's the old phrase, God rest her soul if we break the 0 gamma. So if we're looking for, a flash crash opportunity and violence to the downside, they're short-lived, right? These flash crashes, that's why it has the name flash in it. They can show up in all kinds of places, usually where there's nothing supportive under the market, and the idea that if everybody was to go short at once, for an example, and there's nobody buying the other side, either from hedging dynamics or just for mechanical reasons, there's just nobody on the other side. That's where you can really get a flash crash. It's not just from the idea that there's nothing supportive down there. It's the idea that if everybody is all going in the same direction and nobody's taking the other side, well, then there's a race to see who can get filled the most, the fastest, and they'll start pushing below the bid rather than trying to hit at the bid. And we can see price move down really fast. If you look at it from the daily, the idea that yesterday's midpoint might provide some insight suggests that 59.77 is a level worth keeping an eye on. It's not exactly between the 4 and the 10, but just another level of concern. So we're at 59.92 cog line. We got 59.75. The volatility trigger, put wall 0 gamma, Friday's low, and on down we go. So far, since this last higher low that we put in, we've managed to keep things going, right? So if we clean it up a little bit, we're getting these higher lows nicely, but we're really not getting these higher highs, right? At least not good, clean, like continuation bars. We're getting higher wicks. Higher wicks are not going to get it done, right? So on Friday, we set that higher bar. We closed up here. We need to keep it. Otherwise, we start to fade back, and we end up just setting another higher wick. So on the fade back, we would then be concerned about how these are getting smaller and smaller. And if you don't see it yet, we're forming a wedge. Now, the thing about a rising wedge is that it generally breaks to the downside. But the thing about wedges, if you haven't heard me talk about them before, is how price should not get into the very end of that wedge. Generally, it's I like to say, the last 20 to 25% price should not be in there. And if you do find price inside the end of that wedge, it very often negates the wedge pattern, and we don't get the kind of market move we're looking for. If we're looking for a downward move out of this wedge and we're getting into the apex of that wedge, then it kind of suggests that we won't go down from the wedge, right? That's the takeaway. Since we set this higher low last week, 59.32 cog line, we can't break that now. And that's the pattern. That's the problem with this pattern, is every time we've set these higher lows, we've raised the bar behind us. So if we break that, then we're going to target the 200-period daily moving average, which also happens to be the 20-period daily. They're overlapping right now. That should be really strong support right around that 5,900 level, but I wouldn't expect it to stick, right? So, moving averages are not support in that sort of sense. So let's see the reaction here. See what we get out of it. We can see the last time we were in this zone that it was a supportive area. They bid it back up. We would want to see that sort of defense again if we get down into that level. The problem is the last time we were down here, it was forming a higher low. If we go down there this time, it will be after we broke a higher low. It's a big difference. If we break out of yesterday's range to the upside, we've got the 111 and the 1236. That gets us really close to 60.50, which happens to be a large options level at 60.55, but it's close enough, 60.50. So we got 111 at 60.32, and then 1236 at 60.50. If we're looking for more of a swing trade measure, oddly enough, we get the same number. So that'll work. 1236 lines us up at 60.50. We have no edge this morning with the ADR, other than to say that we can hit the lower ADR simply because it's inside of Friday's price action, and so are we. To hit the upper ADR, we would need to break out of Friday's range, so that's the only edge. It's easier to hit the lower one because we don't need an inside day breakout to do it. Having said that, it is a gap fill, right? That's the liquidity gap that we talked about on Friday. So if we break this pivot low, then that's a play. If we break our own Globex low, then we'll go for the pivot low, and then we'll go for the gap close, level by level by level. Okay. Today's floor pivot has a really wide channel, which implies that if we try to break out, it doesn't stick. It's the same type of channel that we had on Friday, and when we tried to break out on Friday, it didn't stick. We came back in again. Now, these channels don't make price do anything. So the fact that it's telling us a breakout likely won't hold doesn't mean that it's going to make price break out or even make price come back in again. So far, it's an MDP. We haven't hit that, so it's a missed daily pivot. And while we got inside the channel, we did not hit the pivot point. Getting that close and not hitting the pivot kind of implies that we're not going to at this point. Anything's possible. So if we, reject off of Friday's high, or if we break out and get into the 111 and reject, come back in, we would still target that floor pivot. The top of the channel lines up with 6,000, and it didn't help last night. We cut through it in both directions like it wasn't there at all. Today's floor pivot lines up on the weekly floor pivots channel. We'll see if that helps at all. We are on the upside of the weekly pivot. That puts us in a mildly bullish posture. And because of the wide move from Friday, today's floor pivot levels are really wide. They are a long ways off. 59.50 to the downside, 60.50 to the upside. It's quite a distance. Last week's point of control, 59.85, but it's more of a zone. And so far, we tested this zone and it's holding. So we want to continue to see that happen. That kind of reiterates what I had already said We need to hold our own Globex low. And that if we break our Globex low at this point, then we can start focusing on all those levels below. Otherwise, we don't have a clear distribution here. We don't have anything other than a big chunk of volume spread across the entire range, right? It's not even quite a D shape. It doesn't really taper as much as it just ends. $10-day, 30-minute volume profile with TPO. We've got days still before we get into the candles that made the volume that we're using for the point of control. So the only way to see this point of control move any sooner would be if we put in enough volume to move it ourselves. So that would require us coming into this 59.92 area or 59.80 area. We need to get up in here again and put in enough volume to bring the point of control up. Now, it's going to happen at some point in a few days when we wipe out these candles to the left. But we're looking at 2.5, maybe 3 days from now. We can see Friday how the point of control from Thursday was a thing of beauty. You know, sometimes they're really insightful and then sometimes they're just not helpful at all. If you had Thursday's point of control on during Friday's pre-market, then you know, it offered a little bit of insight. After that, though, we ran it over and never looked back. We don't have a new one from Friday. If we did carry it forward, we've already hit it. Now, the textbooks will tell you to carry it forward anyways, right? The fact that I don't shouldn't deter you. I've got enough pivots. I don't need another one. But the textbooks will tell you to carry these 3 lines forward into today's trading session. So if you don't have enough pivots or just want a little more clarity, certainly do that. And then, of course, we got today's profile and today's TPO profile as well. More of a double distribution at this point than anything else, but it's in the lower section. So yeah, we're putting in some work up here. So far, it's not enough. I wouldn't be surprised though if we do get another test of that 6011 cog line, if we don't just bring that point of control up, get it right underneath us, something to lean against. Last week, we looked at the range for this new week, and it was only a projection. It wasn't set in stone at the time, but it was a narrower range than the current week that we had at the time, right? So this was last week's range. This is this week's range. At first blush, seeing it this narrow seems like a pretty good deal. There's less volatility being priced into this week's range. I mean, that sounds good. The problem is we don't know why it's less volatility. Big events that scare the market can cause this to happen because big events are volatility suppressing, like FOMC is volatility suppressing. But this isn't FOMC week. So if there's some other reason for it to be this narrow this week, don't know what it is yet, right? We've got some things on the horizon this week. If you look at the economic events, I don't see any of them that happen to be as big or bigger than FOMC this week. So what gives, right? Therein lies the issue. Now, it could be that things are just finally starting to calm down and the range is narrow because there's just less volatility. That is always a possibility. I don't believe it. And I'm not going to advocate for it because I don't believe it. I'm going to continue to stress that there's something happening this week that the market knows about. That's a key to all of it, right? They can't price it in if they didn't know about it. That they know something is up this week. And the market is saying we're going to go into a hurry up and wait mode. I don't have really good examples of what hurry up and wait mode look like, not off the top of hand, but a lot of times it's a week where we go sideways and we don't do anything because we're waiting on something. 3 days of nothing, right? 2 or 3 days where we just go sideways and we don't do anything, and then we get some sort of news and we break out and really begin to expand. That's a hurry up and wait scenario. Monday, Tuesday, maybe part of Wednesday where nothing happens, and then we get the news and we do whatever it is that the market's pricing in. If that's true, then we're going to hold inside of Friday's range. Now, Friday's a really big bar. So, saying we're going to stay in the shadow of a really big building isn't hard to figure out, right? It's a really big building. But the range that we set today will be the one we have to deal with tomorrow, right? So if we stay in the upper part of Friday's range, that makes Monday's range really narrow. We get into Tuesday, now we've got a narrow range day. It's an NR1. Start getting into NR2. You get the idea. It builds out from there. At this point, all we have is the fact that it's a narrow week, right? That the expected weekly range is really narrow. It's all we have at this point. I say it's enough to cause warning and be on the lookout. What's big enough that's as big as FOMC or bigger that would cause this sort of caution and make them behave this way? We're still 3% above the 10-week, so we're fine. We've even stepped back a little bit. We got to 4%. So we're on the decline, and it's not a negative thing to be declining at this point. We don't want to get, too far ahead of ourselves. So looking at where we're at on the 10-week, we're in a good, healthy spot. Nothing wrong with our location at all. We're not overbought. We're not overextended. We haven't moved too far too fast. It doesn't owe us any sort of pullback or mean reversion. We're just in a good spot. Now looking at the 10-day, we're sitting at around 1%. It's a normal spot. If we were to go back and measure, how often we just kind of hang out in that range in the upper part, you can see that we're there a lot. Sure, we might poke a little bit higher from time to time, but for the most part, this is where we want to be. It's like cruising speed in the car. Nothing wrong with this location. The thing is, if we don't continue to move higher, then the 10 is going to move to us. That's just the way it works. So if we do go sideways today and to tomorrow, then the 10 is going to have a chance to get closer and closer to us. We'll likely get tagged by Wednesday. Bitcoin is up 3% this morning. Over a 5-day period, that basically leaves us flat. We were down about 3.5 over a 5-day period. Now we're flat. We'll see what we get from there. Uranium, Bitcoin again. The VIX is up considerably, which is odd because that means we got spot up, vol up. China, all of these are China. Biotechnology, gold miners, they're not up enough, right? So the things that we need for a bullish day, like the Mag 7, consumer discretionary, chips, cloud services, we don't have any of those this morning. We got Bitcoin, and that's a good start, but that's not going to do it, right? It's too risky. So we need something else. We've got Bitcoin and small caps. That's not the basis for a rally day. But on the other hand, we don't have anything that's really negative this morning either. If you look at what's down, we got nothing. So, from that point of view, yeah, we're waiting on something. So throughout the morning, look for something to push this market into a breakout or a breakdown. Otherwise, it's very likely we're just going to hold the range and go sideways through the day today, maybe testing an inside day breakout and coming back in again, but otherwise just holding the line and waiting for something big. And I don't know what the big thing is, right? Whatever it is. So, I'm open to suggestions. If you guys got any ideas? I just don't, I don't know. Maybe it's QRA early, right? Like, maybe they're kicking around something with the QRA before the next proposal. I just don't know. So we got SMH up a half, silver, which is just ties back into precious metals, China, more China, Bitcoin, uranium, and VIX. So spot up, vol up can turn into a grind day even without the Mag 7. What we want to look for is after we get into the open, that we get a lot of dealer hedging dynamics and options flows, 0-day stuff that start pushing us into a breakout. That can bleed over into the Mag 7, and then we see them start to kick in and help out too. But the difference is that they aren't the reason for the move in the first place. They just hop on the bandwagon afterwards. You could use something like NY Fang. Keep your eye on financials, right? Like I like KRE because it's the banks. It's not so generic as XLF. So the fangs wouldn't be the catalyst or the kickoff. They would just be the followers. Same with market breadth. We wouldn't see all of this start the show. It would start with options, but then all of these would eventually join in anyways. Advancing and declining issues, the banks, the Mag 7, all hopping on to participate in the rally, started by options flow. If it doesn't come from that direction, it's possible we get something out of, dollar yields. But hopefully now that you've seen that wedge, you can't unsee it. And you realize that the clock is ticking, right? It's not perfect, but you get the idea. So the 10-year, we've got that channel breakout. Whatever, it works. If this is a fake break with fast failure, then we're going to cascade down through this really quick and get to retest that 4.33. 4.32 is the line in the sand at this point. That's the swag level. The dollar, just keeping it under 100 is the name of the game at this point. But no fast moves in the 10-year or the dollar. We start getting fast moves in either one of those, things can break. And we are way too deep in this wedge. We shouldn't be that deep into it by now. Remember the 20% rule. So what I got for you guys, be careful, be safe, watch the clock. Look for the trigger for the breakout if there's going to be one. I don't think there's going to be one.